We're heading to the closing bell right now, post-Fed statement and press conference from the Fed chair. Sectors which are trading higher right now, the gainers. Energy is up almost a full percent. Healthcare is up about 0.5%. And here we go to the closing bell for today.
And that closes out today's moves. Again, we are looking at a mixed picture. The Dow taking another leg lower here into the close, and you can see it on your screen right now with the Dow closing off 128 points. The biggest laggards in the Dow today, McDonald's, that stock closing off just around 2% following its earnings. Now we also have Travelers, American Express, Visa, and Procter & Gamble rounding out the worst performers in the Dow today. The S&P slipping back into negative territory, closing just below the flat line. The Nasdaq, though, is able to hold on to gains up just around 100 points. That's a gain of 0.7%. In terms of the sector action that we're seeing today, communication services by far the leader, with the XLC closing up just around 1%. We're also seeing gains from energy, healthcare, and materials. On the flip side, utilities is a laggard, as well as consumer staples. Both of those sectors off just around 0.8%. Real estate also lagging today, with the XLRE off just around 0.3%. Now, we want to bring in our panel for a closer look at today's action and also the reaction that we're seeing in the markets today from the comments that we got from Fed Chair Jay Powell. And we have Tom Essaye. He's the founder and president of Sevens Report Research founder, and also Sandi Bragar. He is a managing director at Aspiriant. And Sandi, let me just start with you. Some of the comments that we got from Fed Chair Jay Powell didn't spook the markets that much. It actually helped the S&P a little bit earlier, and the Dow was off the lows of the day. I guess, how would you characterize, or what's your big takeaway from what we heard from Powell today?
It doesn't sound like the Fed is ready to make any take any big action anytime real soon, Shauna. So from our perspective, that meets our expectations. We are positive on the strength of the recovery. We think that there will be some more fiscal stimulus coming soon, and the labor markets will improve. That said, there are a lot of concerns around, just the economy and the inflation numbers. So we're really being careful in portfolios. The stock market got way ahead of the economy, in our opinion, in 2020. It's been strong in 2021 so far. We wouldn't be surprised if there was a reversal, and our big focus in conversations with clients is on diversification. We think that's more important now than ever.
Tom, did you catch when the chair said they're still writing the speech for Jackson Hole? That makes sense, but there's still plenty of time for a black swan event. And yet you think pretty much what he's signaling is it is going to come at that speech, or at least in the Jackson Hole discussions, the outlines for what will be the taper, right?
Yeah, I think so. They have a history of sort of making these announcements at Jackson Hole. They like that forum. And I think that, look, what we saw today from the Fed was another step towards tapering. I mean, it's not a coincidence that he said we're going to discuss this over the next few meetings, and we've got 3 left until year end, right? So basically what he's telling us is we're going to talk about it, and then we're probably going to do it at the end of the year, assuming everything sort of works as they have expected. I think that on its face, the statement appeared hawkish. We saw that immediate reaction, mostly from programs that were reading and computer programs that were reading the statement. But really, it just met market expectations, and we should all expect a taper coming in December, and for the Fed to continue to walk us down that road. And the market can handle that as long as it doesn't accelerate.
Sandi, you mentioned that diversification is key right now. It's more important than ever. I guess, where should investors make sure that they have exposure at this point?
Shauna, in our portfolios, and I should mention, we're working primarily with corporate executives, family business owners, and entrepreneurs, and we're helping them manage their nest egg for achieving what's most important in their lives. So we're very diversified. We're taking more of a barbell approach. We have about a third of the portfolio in fixed income and liquid alternatives, about split half between the two. On the equity side, we've been allocating between quality companies, so really strong balance sheets, good business models, moats around the businesses. And then also on the more risk side of the equities, we've been diversifying internationally. and have a large tilt toward value stocks, both in the U.S. and international, because that's where we see some opportunity, especially given the resumption of growth in the tech sector, specifically in the U.S.
Tom, have the bond vigilantes lost their ability to pressure the Fed? I mean, when you look at the yield on the 10-year right now, didn't really do much today. It's at 1.26. You know, the whole press conference, the whole thing didn't really, there was a lot ado about nothing.
Yes, it kind of was. And I think that the bond vigilantes, look, I think they're out there, but if we think about the global bond market, as weird as it sounds, treasuries are still attractive to global investors, right? Where else are you going to find a yield on a 10-year bond that's well above 1% with a credit rating like the United States and that has the liquidity to absorb serious flow? It isn't out there, right? And that's part of the reason that treasuries, I think, are still so strong because of the TINA trade. There is no alternative. And our federal government has not quite destroyed the United States balance sheet enough yet to really force people into looking to an alternative. And until that happens, or until inflation really starts to pick up, you know, that international demand for treasuries will keep yields subdued. We see them rising, but they are still subdued, no question about that.
Tom, how long do you expect them to be subdued for? I guess that's the big question at this point. Do you expect them to remain at this low level at least for the next couple of weeks? Are we talking a couple months? I guess, what's your outlook there?
Yeah, so I've said kind of all year I expected to see a 2-handle on the 10-year yield. I'm going to stick by that. I'd be lying if I said that. I'm a bit surprised that we are as low as we are. You know, here we are about to be in August. But the bottom line is we need a catalyst. Right. So in February, we had essentially a failed treasury auction, and then you had a bunch of hot inflation data. That was the catalyst to send the 10-year yield higher. We need another catalyst. Now, I don't know if that comes on Friday via the inflation data. Maybe it comes by Delta variant kind of going away, as some of the medical experts are predicting and hoping that in the next couple of weeks this subsides. But we need a catalyst to get everybody kind of woken up, and then I think it can happen relatively quickly.
Tom and Sandi, we're going to come back to this discussion in just a second, but Dan Howley's standing by right now. We've got earnings from Facebook. Dan? Dan, I think you might be muted.
Sorry about that. Still cannot get used to it. We have Facebook revenue of $29.08 billion. That's versus $27.86 billion as expected. Advertising revenue of $28.58 billion versus expectations $27.13 billion. That just shows that the advertising market is coming back. We saw that previously with Snap when they had reported. And then we were looking for a family daily active and monthly daily active to be higher this quarter. But obviously they're doing a lot better than expected just based on that advertising revenue. And that's where really the money is basically made for Facebook.
All right, we can see the stock under pressure a bit after hours. Dan Howley, it's certainly a story that we will continue to follow here. But we also want to get to Ford earnings because Ford releasing its earnings report here just a minute or so ago. Ines Ferre has that for us. Ines?
And Shauna, it's a beat on the top and the bottom line with Ford coming in with revenue for its second quarter at $24.1 billion, and that's above estimates. Also, its adjusted earnings per share coming in at 13 cents. That's compared to a loss per share of what the street was expecting of 5 cents. So certainly a beat. Also boosting its year outlook with Ford's expectations for better full year 2021 operating results, driven by strong order bank and also improving semiconductor supplies. Something very important that the street was going to be paying attention to was the chip shortage that has affected the auto companies within inventory. So certainly some positive commentary here, and we can see that the street's liking this with the stock up about 2% in after hours. Shauna?
All right, thanks so much, Ines. Jeff, you can see shares moving to the upside here. I want to bring back in our panel. And Sandi, just to zoom out a little bit and talk about the earnings results that we've gotten over the last couple of weeks and what we're seeing so far for the quarter, because obviously expectations were high going into this. A lot was riding on these reports. Some companies like Facebook, as you can see today, disappointing what the street had been expecting. But what's your overall reading on the numbers that we've been getting over the last couple of weeks?
Well, we think the numbers have been reflecting what's happening in the economy with the continued recovery. A lot of clients are asking us about stock market prices. They're concerned as the stocks have been revisiting highs, all-time highs, and are concerned that maybe this is the time to start selling out of stocks. As I mentioned before, we think it's important to be invested, and we definitely want diversification. And if clients have cash needs coming up, that is something we're considering and taking some cash out of the portfolio to make sure there's money to cover those. But other than that, no surprises on the earnings side from our perspective, Shauna.
Sandi, were you upset with the news today that they have a deal on infrastructure? Because I know you're concerned about government debt, and they say, hey, they have a way to pay for it. But boy, Washington accounting means more debt, doesn't it?
It sure does. And I think in the near term, Adam, that's probably a good move. That continued stimulus that will come through the package will help out. But overall, we are concerned as we look out in the years ahead with the amount of debt that the U.S. government has. Public debt is now at 110% of GDP. That's nearly twice the level it was at back in 2008 when we were going through the global financial crisis. And the Fed's balance sheet is pretty fat too at $7.5 trillion. So we have concerns about that as we look ahead and see some interest rate rises happening in the 2022 period. That's when you start really feeling the impact of public debt on the economy. So again, diversification.
All right, well, the numbers keep rolling in. Qualcomm also releasing its report. Dan Halley has that for us, Dan.
That's right. That's a beat on the top and bottom line for Qualcomm. They brought in $8 billion in revenue versus $7.57 billion expected. $1.92 for their earnings per share over $1.69 that was expected. And Christian Amon, the new president of Qualcomm, says that they are on pace, thanks to 5G transition, to deliver $10 billion of annual revenue across their RF front end, their IoT, and automotive as their business continues to diversify. They're obviously trying to stretch out that IoT, Internet of Things business, as well as the automotive business where their chips are placed into vehicles. That obviously a good sign for them to be spreading that out around, especially as we see that chip crisis hurting other companies, but not quite Qualcomm.
Dan Howley, thank you very much. Also, thank you, Tom Essaye, founder and president of Sevens Report Research. Also, Sandi Bragar, managing director of Aspiriant. Good to see both of you, and thank you for joining us.